Most people think the stock market is some dark, mysterious beast, reserved for guys in suits with Bloomberg terminals and god complexes. It's not. It just gets explained by those same guys in their language for their benefit. Let me change that. Forget everything you think you know. We're starting from scratch. What actually is a company? Picture a bucket. Not a fancy one. Just a regular bucket. Now start throwing things in. Trucks, laptops, office buildings, a factory floor humming at 3 a.m. That's the obvious stuff. You can see it, touch it, sell it. But now throw in something you can't hold. A logo people trust. A name people recognize. A reputation built over decades. Suddenly, that bucket gets a lot heavier. Take Apple. Sure, they've got warehouses stacked with iPhones. But the real magic? Their brand is so powerful, so deeply wired into people's brains, that customers will happily pay twice what they'd pay for a competitor's phone. Same glass, same chips, different logo. That's not manufacturing. That's psychology, and it's worth hundreds of billions of dollars. So a company is just a bucket, stuffed with valuable things. Some you can see, some you can't. Simple as that. Now, who owns the bucket? Let's make this personal. You're a carpenter. You've spent 3 years saving up $10,000. That's real money, real sacrifice. But there's one problem. It's not enough. You need a truck. You need tools. You need to actually start. So you call your friend Jake. He lends you $10,000 at 5% interest. No ownership. No stake. Just a loan with a fixed return. Now you've got $20,000. You buy the gear, and you get to work. 1 year later, you've made $50,000 in profit. The truck's still yours. The tools are still yours. Life is good. But now comes the big question. How do you settle up with Jake? Here's how it actually works. Jake lent you money. He didn't bet on you. So you pay him back his $10,000 plus 5% interest. $500. Done. That's the entire deal. Everything else, yours. In finance, Jake is a bondholder. You're the stockholder. Think of it this way. A bond is a handshake deal. Lend me money. I'll pay you back with interest. Guaranteed return. Lower risk. A stock is a partnership. Invest in me, and you own a piece of what I build. No cap on the upside, but no guarantees either. Jake hears about your $50,000 profit and thinks, wait, I only made $500. And yeah, fair point. But flip the scenario. What if the jobs dried up? What if you made nothing? You'd have to sell the truck, sell the tools, and hand Jake every single dollar first. He'd walk away whole. You'd walk away with nothing. That's the deal you both signed up for. Bondholders get paid first, but only what was promised. Stockholders get paid last, but keep everything that's left. That rule, it never changes. How do you grow bigger? 2 years pass. Word spreads. Your carpentry business is absolutely crushing it. You want to expand, new cities, new crews, more trucks. But this growth needs serious cash, and taking on that much debt feels dangerous. So instead of borrowing, you do something different. You sell pieces of your company. Maria buys in, then Tom, then a dozen others. That money flows straight into the business. New equipment, new locations, real expansion. In exchange, they each own a slice of everything you build from here. This is called an IPO, an initial public offering. It's the moment a company first opens its doors to the public and says, you can own a piece of this. The money raised goes directly to the company. It's the one moment that matters most. After that, it's a different game entirely. The stock market. What it actually is. A year later, Maria needs money for something else. She wants out, so she finds someone willing to buy her shares, and that person pays her. Not you, not the company, just Maria. Think of it like a used car. Toyota gets paid once. when the first buyer drives it off the lot. After that, the car gets passed from owner to owner, and Toyota never sees another dime. Stocks work exactly the same way. After the IPO, companies don't touch that money again. Shares just flow between investors. Millions of trades every single day. That is the stock market. You've heard of Wall Street, the New York Stock Exchange. There's this famous image, guys in color-coded jackets, screaming and waving papers on a trading floor. That still technically exists. But today, the stock market lives in your pocket. Robinhood, Fidelity, eToro. You tap a button, someone else taps theirs, and suddenly you own a tiny slice of Google. The whole machinery runs in milliseconds. Every year, trillions of dollars change hands this way. Almost none of it goes to companies. It's just people swapping ownership, constantly, around the clock. So why own stock at all? Great question. If your money isn't going to the company, what's the point? 2 reasons. 1. The price goes up. You buy at $50. 2 years later, everyone wants a piece of this company. You sell at $100. You just doubled your money without doing a single thing. 2. Dividends. Some companies take their extra profit and distribute it directly to shareholders. Like a thank you for owning a piece. You hold 100 shares. They pay $2 per share. You wake up to $200 in your account just for existing as an owner. Coca-Cola does this religiously. Amazon doesn't. Not a single cent. Instead, they take that cash and build 10 more warehouses, launch new products, and try to get twice as big. Both approaches can make you wealthy. They're just different philosophies. Why do prices actually move? Supply and demand. That's really all it is. Lots of people want to buy, but few want to sell. Price goes up. Lots of people want out, but few want in. Price drops. A stock is worth exactly what someone is willing to pay for it in this moment. Not $1 more. But what makes people want to buy or sell? They're betting on the future. Apple announces a product that changes an entire category. Investors think profits are about to explode. They pile in. Price surges. A company posts ugly earnings numbers. People panic. They bail. Price tanks. Sometimes the logic is razor sharp. Sometimes it's pure unfiltered emotion. Fear and greed spreading like wildfire through millions of people all at once. News, rumors, interest rates, political drama, a CEO's tweet. All of it feeds into how people feel about what a company will be worth tomorrow. And those feelings, rational or irrational, move prices today. What should you actually do? Here's where I'll be straight with you, because most people won't be. Don't pick individual stocks. Don't try to outsmart the market. Don't chase the hot tip your cousin texted you at midnight. I'm not being harsh. I'm just telling you what decades of real data say. The majority of professional fund managers, people who do nothing else for a living, fail to consistently beat the market. If they can't, what's the realistic shot for someone checking their portfolio between meetings? Instead, do something beautifully boring. Buy a little bit of everything. There's a tool built exactly for this called an index fund. One purchase, hundreds of companies. You instantly own tiny slivers of Apple, Amazon, Google, Walmart, JP Morgan, Tesla, the whole engine of the economy. The most famous index tracks the S&P 500, the 500 biggest companies in America. When you buy it, you're not betting on one company. You're betting on American business as a whole. Over the last century, that bet has returned roughly 10% per year on average. Some years were brutal. Markets crash. Headlines scream. Everyone panics. Some years were extraordinary. But zoom out over decades, and the line goes up. Consistently. Relentlessly. Invest regularly. Ignore the noise. Don't sell when it drops. Just wait. That's not a secret strategy. That's not a hack. That's just how ordinary people, without Wall Street connections or finance degrees, have been quietly building real wealth for generations. Let's wrap it up. A company is a bucket of valuable things, some visible, some not. Stocks and bonds determine who owns that bucket. Bonds get paid first, but only what was promised. Stocks get what's left, which can be nothing, or it can be everything. When you buy stock, you're almost never buying from the company itself. You're buying from another investor who no longer wants their piece. Prices move on supply and demand, fueled by people endlessly guessing about the future. You profit two ways. The price goes up, or dividends land in your account. And if you're starting out, index fund. Patience. Time. No drama required.